What if I told you setting aside just $100 each week can actually make you $1 million? At first glance, that doesn't seem like much. It feels like the cost of a dinner out, a new pair of shoes, or a small grocery store run. But if you invest wisely and consistently, that $100 can snowball into a fortune that changes your life. Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Over the past decade, one particular type of investment has returned an average of more than 21% annually. That kind of performance is the reason so many people have reached financial independence and even retired decades earlier than expected. And the best part, you don't need a trust fund, you don't need a six-figure salary or Wall Street connections to begin. You can start with a single dollar and you can scale yourself up to $100 each week or more if your budget allows for it. In this breakdown, I'm going to show you exactly how to take that $100 and spread that into a simple three-part portfolio. The strategy balances growth, diversification, and income so you can accelerate your journey to financial freedom. So without further ado, let's get right into the video. One of the biggest misconceptions about investing is that you need a large sum of money to get started. People often wait until they have thousands saved before they begin investing, but the reality is time is far more valuable than starting with a large lump sum. When you invest $100 every week, that's $400 a month, and that's about $5,200 each year. With compound growth, those steady contributions can add up to hundreds of thousands of dollars over the course of years. Let's say you consistently invest $100 each week into a portfolio that averages 10% per year. After 20 years, you'll have contributed around $104,000, but your portfolio will be worth over $300,000 thanks to compounding. Stretch that out for 30 years and that number grows into the millions. The key takeaway is that consistency beats occasional big wins. Even if you don't have thousands to drop at once, showing up every week and putting your $100 to work is how wealth is quietly built. The first stop for our weekly $100 is the Vanguard Total Stock Market ETF, better known by its ticker symbol VTI. Out of our $100, I would suggest putting $50 here. So why start with VTI? Because it's one of the most complete and diversified investments available to everyday investors. With a single purchase, you own a slice of over 3,500 US companies. That includes massive giants like Apple, Microsoft, Nvidia, Amazon, and Meta, but also thousands of smaller companies that most people have never heard of. With VTI, your money is spread across different parts of the economy, with roughly 37% in technology, 14.40% in consumer discretionary companies, and 12.80% in industrials, among various other sectors. Keep in mind though, changes in sector allocation will happen. Normally they change due to active management decisions or shifts in the underlying index that the ETF tracks. VTI essentially mirrors the US economy. When the economy grows, VTI grows. When technology surges, manufacturing booms, or consumer spending spikes, you benefit because VTI is spread across nearly every sector. Another reason VTI is such an attractive foundation is its cost. Every ETF has something called an expense ratio. Now, this is a fee that's deducted from the fund's assets to cover operational cost. In VTI's case, the fund's expense ratio is just 0.03%. So that means if you invest $10,000, only $3 goes towards management fees each year. Now, if you're not familiar with anything I'm talking about right now, please refer to my best ETFs to buy now and hold forever video. In that video, I go over what ETFs are, different types of brokerage accounts that you can use to purchase them, as well as more information on expense ratios and my other favorite ETFs I think you should consider buying. I'll link that video here. I highly recommend watching it after this video. Now, back to VTI. Nearly all of your money stays invested and continues compounding for you. Performance-wise, VTI has been no slouch. Over the last decade, it has delivered an annual rate of return of 13.94%. Even in the past year alone, it returned 15.78%. It's not flashy, but it is very powerful. By putting $50 of your weekly $100 into VTI, you're ensuring that your portfolio is always grounded in the entire stock market. That's diversification at its best. Now that we've built a solid foundation, it's time to turn up the growth potential. The next piece of our $100 goes into the Vanguard Information Technology ETF, or VGT. Here we allocate $30 each week. VGT is a focused fund, zeroing in on 315 technology companies. That includes the most influential and innovative players of our time: NVIDIA, Microsoft, Apple, Broadcom, and Oracle, among others as well. Technology has driven much of the economic growth over the past few decades, and it continues to be an engine of progress. From artificial intelligence to cloud computing to semiconductors, tech touches nearly every industry. VGT allows you to capture that explosive growth in a single investment. The fund sector breakdown shows just how forward-thinking it is. 32.60% in semiconductors, 22% in system software, and nearly 14.80% in application software, which makes up a majority of this ETF. These are companies building the tools, platforms, and infrastructure that powers our digital lives. The results speak for themselves. Over the last 10 years, VGT has averaged an incredible 21.6% annual return. And in just the past year, VGT has returned 22.07%. The fund's expense ratio is 0.09%, and that means if you invest $10,000, only $9 goes towards management fees each year. That type of performance is why many investors pair a broad market fund like VTI with a specialized growth fund like VGT. One provides stability while the other accelerates your wealth building journey. By putting $30 of your weekly investment into VGT, you're giving your portfolio the rocket fuel it needs to potentially shorten your path to financial independence. The final piece of our $100 strategy is the Vanguard Real Estate ETF, ticker VNQ, and each week $20 would go here. Now, I'm sure you're thinking, why would you want real estate in the mix when stocks have historically delivered stronger returns? The answer lies in diversification and income. VNQ invests in around 150 real estate investment trusts, also known as REITs, which are companies that own and operate income-producing properties. These include healthcare facilities, rental centers, office buildings, and even telecom towers. By holding VNQ, you gain exposure to a part of the economy that doesn't always move in sync with the stock market. When tech stocks are volatile, real estate often provides stability. The sector breakdown of VNQ leans heavily on income-producing real estate, with 13.7% invested in healthcare REITs, 13.2% in real estate REITs, and 11.5% in telecom tower REITs. But here's the trade-off. Over the past decade, VNQ has averaged only 5.36% per year, and in the last 12 months, it returned just 2.4%. That is a far cry from the stronger results of VTI or VGT. So why does this still deserve a spot in your portfolio? Because VNQ brings something the others can't: direct exposure to real estate. While VTI and VGT spread your money across the stock market, VNQ invests in companies that actually own and manage physical properties. Now, the fund's expense ratio is 0.13%, which is higher than VTI or VGT. So that means if you invested $10,000, $13 of that goes towards management fees each year. However, this is still low compared to most real estate funds. But here's where it really shines: income. VNQ currently pays a dividend yield of around 3.8%. That's more than 3 times higher than VTI and significantly more than VGT. This income can play 2 roles in your financial plan. While you're still building wealth, you can reinvest those dividends to buy more shares, compounding your growth even faster. Later on, when you're closer to financial independence, you can use the dividend income as part of your cash flow to cover expenses. So adding VNQ to the portfolio doesn't just replace growth, it balances it. It brings in consistent income and smooths out the ride when markets get bumpy. So let's recap why we chose these 3 ETFs. The answer is that together they cover 3 essential pillars of a strong portfolio. First, VTI gives you diversification. You're not betting on one company, one industry, or even one sector. You're invested in nearly the entire US economy. Second, VGT brings growth. It focuses on companies shaping the future and has a track record of delivering outstanding long-term returns. Third, VNQ provides balance and income. It invests in real estate, which doesn't perfectly correlate with the stock market, and it pays dividends that can either compound your wealth or support your lifestyle. With $100 a week, the allocation breaks down to $50 in VTI, 30 in VGT, and 20 in VNQ. That's a 50-30-20 split that covers diversification, growth, and income in one simple package. Now, let's really bring this to life with an example because numbers on a video don't always hit home until you see them in action. Imagine someone named John. John isn't a Wall Street genius. He's not sitting on a trust fund. He's just a regular guy with a regular paycheck. Every week, instead of blowing $100 on takeout or entertainment, he decides to invest it. And he sticks with this strategy, 50% into VTI, 30% into VGT, and 20% into VNQ. Now, here's what that mix looks like in terms of performance. VTI has averaged about 14% annually over the past 10 years, right? VGT, which has been in the tech rocket ship, has averaged a massive 21.6% over the last 10 years, and VNQ, the real estate play, has brought around 5.8% with the added benefit of steady dividends. Now, I did some rough math because you have to account for dividends and other things like that, also inflation. When you combine those three with their weights, you get what's called a blended return. Half of John's portfolio rides the 14% from VTI, 30% taps into the 21.6% from VGT, and the last 20% gets that 5.36% from VNQ. When you add all of that together in John's portfolio, he has an average annual return of 15.4%, roughly, because again, we're averaging this out for 10 years. Each year would be different, but if we were to just do some rough math, 15.4% would most likely be the average over the next 10 years. Now, here's where it gets exciting. John invests $100 every single week. That's about $5,200 a year, and after 10 years of consistency, his portfolio has grown to roughly $113,000. Remember, he only contributed about $52,000, but compound growth did the heavy lifting. If you push that out to 20 years, John's portfolio crosses over $420,000. Again, he only put in $104,000, but the growth multiplied his money by 4. Now imagine John keeps this up for 30 years. At that point, his portfolio doesn't just grow, it explodes. That same $100 a week will build into $1.6 million, all because he stuck to the plan and let the power of compounding that 15.4% average return work for him. The point here isn't that John is some outlier. He's not. Anyone can do this with discipline, patience, and consistency. The secret isn't a one-time big win. It's showing up week after week, putting your money to work, and letting time do the rest. Now, some of you are probably thinking that's great for 20 or 30 years down the line, but what if I want to hit $1 million faster? Well, let's walk through that as well. We already know that our blended portfolio has averaged around 15.4% annually over the past decade. So let's flip the question. Instead of asking how you'll end up if you invest $100 a week, let's ask how much would you need to invest each week to hit $1 million in, let's just say, 10 years. So here's the math. To get to $1 million in a decade at a 15.4% return, you need to invest about $1,000 a week. That's roughly $4,000 per month, or just under $52,000 a year. Now, I know that number might sound big, but think about it. If you're already running a business or have a high-paying career, or you can find ways to drastically increase your income and reduce your expenses, then it's not impossible. And the payoff is massive. By consistently putting $100 a week into this strategy, you're setting yourself up to cross the $1 million mark in just a single decade. And time passes by so quick. Even if you can't quite swing $1,000 a week, every step closer you get makes a huge difference. Maybe you start with $200 or $300 a week. This doesn't just get you to 1 million in 10 years, but it could put you halfway there. And over 15 or 20 years, that same consistency will still build serious wealth. The takeaway is that the formula works. The only thing that changes is how much fuel you're willing to add to the fire. Now, here are my final thoughts. Financial independence isn't about hitting the lottery or landing a massive windfall. It's about building habits that stack in your favor over time. $100 a week may not seem life-changing today, but give it 5, 10, or 20 years and the results can be extraordinary. And very quickly, I want to address the people in the comments who are going to make the excuses. So they're going to say, I didn't account for inflation, or they'll bring up taxes, or they'll say it takes too long, or they're going to say, where can I get an extra X amount of dollars? Here's the thing, guys. I make content for people who are looking for solutions and results, not people who are going to make excuses. The math doesn't lie. The math will work. People that stay financially deficient versus people that are financially wealthy, the only distinction between these two people are their mindset. That is it. And I'll give you an example from my personal life, of course. So I remember when I bought my first stock. It was with T-Mobile. At the time, I was working for them. They just launched their IPO. So I bought $50 worth of T-Mobile stock, and I just completely forgot about it. And then I looked around like 3 years later, and the stock was $115. And you know what I said to myself? The same thing you're probably thinking right now. That's nothing. Like, that's $115. That's absolutely nothing. If you thought that same thing, that's the mindset issue that I'm talking about. If I put in $50 and got back $115, I literally got back everything I put in. That is over 100% of a return into my investment. So I get that, yes, $115 isn't a lot relative to the cost of living, but you know what that means? You should probably put in more, right? If you guys stop looking at money as in what this money can buy me right now, and just start looking at the math, then this was an incredible thing that I turned $50 into $115. Because think about it like this. If you put $1,000 somewhere and you got a 100% return, that's $2,000, right? Doesn't that sound amazing? If you put $10,000 somewhere and you got a 100% return, you just got $20,000. Does that feel small? 50 to 100 or whatever the case may be is no different. It's percentage based. That's the part that we don't understand. That's the part that we don't get about compounding, because we're only looking at what's happening right now relative to what we can buy today. Eventually, if you do this same thing long enough, you won't even think about it. And that's what success is about. You'll start doing something that makes you feel uncomfortable in the beginning, but eventually you start to become this over time without having to really think about it too much or put in any effort. Building wealth isn't difficult. It just takes consistency and patience. And I think that's the hardest thing for people to grasp. You don't have to be smart to make money or to build wealth. You just need to be disciplined, and you just need to be consistent. And again, if you want to make more money and make this go faster, then learn a skill, learn a high value skill, start a business. If you don't know how to do anything, learn something. The point is that no one can stop you from being successful except for you. And no matter what, everything you do in your life compounds. If you make a bad decisions compound if you keep making bad decisions. If you make good decisions compound over time. You can look at that if you were to exercise with your health. Everything compounds over time. And the thing is, if you put in very little compounds. If you put your all into something, not just money, but your life. Look at that like your life. If you put everything into something, the opportunity for that thing to compound is exponential. So that's all I wanted to say. That is my 2 cents. I don't want to bore you guys with it feeling like a lecture, but this information to me, if it was broken down like this when I was 20 years old and I would have done this for, let's say, 20 years, I could have guaranteed that I probably would have had over $1 million. For me personally, I could have done that if someone made this for me and I saw it at the right time. So I'm making it for you guys because no one made it for me. All right, I want to thank you guys so much for watching this video. If you got any value from this, please like, comment, subscribe, share this with anyone who might need some information as far as investing. Maybe they don't know where to start, and maybe this will be the thing that makes it a little bit easier for them to get started. If you started this process or you're purchasing ETFs right now, please drop a comment below with your favorite ETF and tell me why. I would love to hear that, and other people in the comments may find some great ETFs or great stocks with a great rate of return, because you don't have to stick to these 3. You can always find other investment opportunities that may have higher annual returns. I think this is the one that'll probably be the most balanced and the easiest for anyone to do, no matter if they work a 9-to-5 job or they're an entrepreneur. Pretty much everyone can start this process, and you can do it with as little as $1. Once again, thank you so much for watching this video, and you guys have a wonderful day.